would you make one change? Simple. Change where this goes first. The money you save, just don't put it in the bank anymore. Don't put it in Wall Street anymore, because Wall Street ain't giving you guarantees. We're going to custom design and engineer your policy for your specific needs and goals. Simple. You've now just found a way to earn interest and dividends on your full balance while still being able to use it. We have literally just taken back the banking function in our life doing this. This is one of the greatest assets you will ever have. What's going on, everybody? Welcome back to another wealth webinar where we're going to show you one simple thing, and that is how to take back control of your money. And I'm going to show you that by teaching you how to be your own bank. Now, before we get in, I always like to do a little bit of housekeeping on these, and I want to ask each and every single one of you, who's here for the first time right now? So we got almost 100 people in the chat. Put I if this is your first time here. And the reason I ask this is I try to gauge what I'm going to go into and how I'm going to show this, because if a lot of you have already kind of gone through the 90-minute video, you've already seen this, I don't want to spend too much time on the basics, the fundamentals, although I'm okay with that. I've got some really exciting stuff, and here's what you're going to learn today. So today, the two things I want to accomplish is I want to talk to you about the concept. I want to show you what it is, how it works. The concept I'm referring to is, some of you might know it as BYOB, be your own bank, but the real name of the concept is the infinite banking concepts. That's the most important thing. And the thing I want to preface is the infinite banking concept really involves two pieces. Number one, it involves a machine. We got to have a machine to run our money through. That machine, as most of you know, or maybe don't, is a specially designed whole life insurance policy. So we're going to cover that. We're going to talk a lot about the machine. Why do we use the machine? Why a whole life policy? What does it mean when we say specially designed? How specially designed can it be? We're going to talk about that. But the other thing we're going to talk about is the process, because the infinite banking concept is not a product. So a lot of people, especially even industry people, they want to think that the infinite banking concepts pioneered by the late R. Nelson Nash in his book, Becoming Your Own Banker, he made it very clear. The infinite banking concepts is a process. That's all it is. So what does that process do? That process allows you to take back the banking functions in your life. That's pretty simple. So wherever you're giving up the banking functions, you're going to take that back. In other words, you give up your money. You give up all your hard-earned money that you go out there and you earn and make. You give that up to a bank. Well, we're going to take back some of that control, because when you give it to a bank, the bank's in control, and I'm going to hit that. Secondarily, when you give it to credit card companies, when you give it to car finance companies, when you pay somebody else a payment on a debt, that is you giving up the banking function. We're going to take that back. In other words, think of all the debts, all the loans that you have out there right now. Imagine if every one of those checks that you write to somebody else's bank were checks you wrote to you and you got to save. And I had somebody in town yesterday. They were in town, and we were out to dinner the night before, and I was explaining it, and they're like, I get it. I understand the infinite banking concept, but I'm just missing this piece. Today, I'm going to explain that missing piece, because if that's one thing she was missing, and she's very good at understanding the infinite banking concepts, but she was missing this one little piece, and it was a mindset piece. So we're going to cover that mindset. We're going to cover that missing piece that she was lacking. And as soon as I said it, a light bulb went off and it clicked. So let me just take a look at the chat. And folks, listen, a little other housekeeping. If you have questions, you're welcome to put them in the chat, but today it's just me. So I got Shauna sitting there. Say hello to Shauna in the chat. Say hi, Shauna. She's in the chat. She's watching over things. We've got an event coming up August 9th and 10th. That's going to be an advanced IBC training, a virtual training. We're going to talk about that. But Shauna's here with us. So we're definitely going to lean on Shauna to help us with these chats and kind of just make sure that all of you are getting, your questions answered. However, because I'm going to be teaching, I'm only going to be focused on the Q&A. So right now we got a question in there from Deborah. We got a question in there from Chris. So if you have questions as we get into this, I want them to go in the Q&A, and I will make sure before we're done with this webinar, your questions get answered. Fair enough? All right, so we got them all coming in. Everybody's ready. We got a whole bunch of new folks. That's great. So since we got a lot of new folks, I got to do my job, and I got to kind of take all of you through just the bare bone basics. Is that okay if we hit some of the fundamentals today? So what I've got now is with this new fancy dancy little board, I want to kind of talk a little bit about this slide because I'm going to go back to the fundamentals. Here's a really important thing. And I hear this all the time, but I think for all the folks that are here for the first time, this is really important. You are all now part of the 5% group right here. You're the 5%ers. How do I know that? Well, I know that because you're here. You see, there's 100% of the people out there. And if you look at statistics, and I'll give you the statistic right here, and if you just look at the board, out of 100 people, folks, out of 100 people, only 5 of those 100 people are going to be financially secure at the age of retirement. So just think about that. Whatever retirement age is for you, 63, 65, 60, 55, whatever. Just know that out of 100% of the people, or 100 in this sampling, only 5 are going to be financially secure. And out of those 5, only 1 is going to be wealthy. That should wake you up. I mean, this is the United States of America, the land of opportunity, the land of the free. How can it be that only 5 out of 100 are going to be financially secure? I have figured that out. Actually, Earl Nightingale has figured that out. It's a mindset problem. The difference between the success and the failure financially is simple. The 5, which is you folks, you are the 5%, all of you are willing to create. You're willing to create that financial future that you've dreamed of. You're willing to create that financial abundance. So the 95%, what did they do? Conformed. Very simple. They conformed to a system. They conformed to somebody else's ideas, somebody else's dreams, somebody else's failed financial plan. If you think about the mass amount of people, what do they do with money? They go out, they trade hours, the most precious resource we have, which is our time. They trade hours for money. They say, okay, I am worth $100 an hour, and I will work 40 hours a week. You're trading hours for dollars. First thing you need to know, whether $100 is a lot of money or not a lot of money to you, let's just say it's $1,000 an hour, $10,000 an hour, $100,000 an hour. It doesn't matter what dollar amount you put on your hour, it's not enough. Because your time is the most valuable resource you have. But that's what we've been taught to do. Trade hours for dollars. And then we've been taught to take the money that we earn, and we've been taught to put that money in somebody else's bank. It's exactly what we've been taught to do. We've been taught to take the money we make, put it in somebody else's bank, and then they pay us an interest rate, or maybe they don't. And then from there, when it goes in the bank, what we do is we go out there and we live life. We have expenses. We got rent, mortgage, we got groceries, we got diapers, we got food and going out and entertainment. We got all these things. And then, after we get done spending all the money that we made, what's left? What's left is your savings. This represents your savings. Now, here's a mathematical certainty. If you are not saving 10% of your earnings, if you're not keeping 10%, you are behind the 8 ball. That's a mathematical certainty. And there's really nothing I can tell you that will change that. We've got to get you to a point where you are saving at least 10%. If you're saving more, awesome, gravy. But if you're not saving 10% of what you make, we need to make changes. And the reason people don't is throughout life, we basically buy things, and we buy things that maybe we can't afford, but they make it so simple. Notice how I said they. I'm referring to the institution, okay? Banks, whatever you want to call it. They have made it so simple for us to get money for the things we want, from lawnmowers to beds to furniture to houses to cars. Everything that we want, we can basically get the money from the institution, and then we can agree that we will pay a monthly check to that institution, and that monthly check includes interest and principal. So that's what we've done. And when we've accumulated too much of that debt, too many credit cards, lines of credit, too many car payments, student loans, house payments. You've heard the statement, I'm house poor, okay? When we've done that, we are now at a point where we can no longer save 10%. And that's where the problem starts. But it's not where the problem ends, okay? Because you can go deeper and deeper. With credit cards today, people have gotten to the point where now they're literally starting to act like the government. They're spending 110, 120% of what they make. They're literally going backwards. But here's the easiest part. If you learn how to take back control of your money, and if you learn the infinite banking concept, you indeed can learn how to build wealth through your own debts and expenses. Literally, all your debts and expenses can become one of the greatest assets. Listen, Robert Kiyosaki in his book, Rich Dad, Poor Dad, talked about turning liabilities into assets. The 5% here have learned how to turn liabilities into assets. You know who else knows how to turn liabilities into assets? Does anyone know? I can tell you. The person that knows how to turn liabilities, or the institution that knows how to turn liabilities into assets, is none other than traditional banks. They are the best at turning liabilities into assets. Does everybody understand that? Well, let me kind of go through. I want to go to this one, all right? Because I think all of you can understand this. Banks, what do? We go out there, and what do we do with banks? We make deposits in banks, all right? So here, so what we're going to talk about is we're going to talk about when you make a deposit in the bank. And I'm just going to use 100 grand. Folks, you can use any number you want. I'm just going to use $100,000. And hopefully all of you can see this. If not, I'll just write $100,000. You put the money in the bank, and the bank agrees to pay you an interest rate. Let's call it 4%. Okay, 4% is the number we're going to use. Now, how many of you have a bank that's paying you more than 4% right now? Does anyone have a bank paying you more than 4%? Anyone? Put I in the chat, because I want to know what percentage you're making if it's more than 4%. Okay, Jeff says no. Jeffrey says no. All right, so let's just go with 4%. So you're making 4%. When you make the deposit, is your deposit an asset or a liability to you? It's an asset, right? So to you, that deposit is an asset, but to the bank, your deposit is a liability because it's not their money. They owe that money back to you. So what banks do is banks go out and they convert liabilities into assets through loans. Okay, this is what I teach. Very simply, they take and they loan your money out. In this scenario, to someone buying a house. Okay, seller is selling them a house, and the bank charges, let's just use 7%, pretty appropriate number for today's standard. So you put your money in the bank, and the bank paid you 4, but the bank then takes your money immediately and lends it out at 7. What are they doing in between? What has the bank successfully done? They've created a spread. Can we all agree that the bank is making a spread? 7 minus 4. Okay, you guys got that? That's pretty cool, isn't it? How many of you would like to do what a bank does? Would love to take money and make a spread on that money 24/7? Well, all of you are going to learn how to do that. But the beauty is, every single one of you, with what I'm going to show you, can make a spread just like the bank, because you're going to be in control of your money, and you're going to take that ability, that banking function, away from the bank, and we're going to put it back on you. Okay, fair enough? Because the bank now has control. The bank is acting in its capacity and using its functionality as a bank to do this. Now, when the bank made that liability, or took that liability, your deposit, and lent that out, what did it become to a bank? An asset. Because that loan right here, that mortgage, which is a first lien position for the bank, that is now an asset. So on their books, that deposit, which is in the liability section of their balance sheet, now shifts from liability. Well, it stays on as liability, but it becomes a bigger asset. Why does it become a bigger asset? Well, because even if we just do dollar for dollar, 100K, let's just say this house was 100K, just keeping things simple. It's not just 100K, it's 100K plus the 7%, and all they're doing is giving back 4% of that. And I'm not even going to get into the velocity of money. So that's how they do it. But see, the banks and the whole institution has figured out how never to give up control. They never give any money, they don't give any control away. Because when that person bought the house using your money, your deposit, that seller got the money. And what did the seller do? What have they been taught to do? Take the 100 grand they got for the house and put it back in the bank. Which basically, I'm going to go quick here with this, but what that allows the bank to do is lend that money out over and over and over again. And every single time they lend it, I'm just going to put them all on the screen here. Every time they lend that money out, they make a spread. So let's just put that on the board. As we can see, I talked about a spread here, but if they're paying 4 and they're charging 8, it's a bigger spread. If they're paying 4 and they're charging 9 on this home remodel loan, 12 on this debt consolidation loan, up here in the car loan, they're charging 8. If all we did is we went through and we just added it up, 3% was the spread here, 4% was the spread here, 5% was the spread there, and 8% was the spread there, you now see how much money a bank makes. Net. The bank made 20% and you made 4%. Let me repeat that again. The bank made 20%, you made 4%. So if the bank made 20 and you made 4, and we divide 4 into 20, that is 5 times or 500% more than you made. I love teaching this, folks, and that's why I put it on the board, because this puts it into perspective. This is what's happening day in and day out. And all the bank needs to do is just lure you into doing more spending, more credit cards, lure you into wanting to do more home remodel loans, buy more cars, and buy more houses, and all the things that you finance. The bank just needs to get you to do more of that. Because if the bank can get you to borrow more money, that means the bank can move more money from liabilities to assets. You see, if all of us got smart to this, and all of us just said, hey, I'm going to become my own bank, what you have done is you have taken the banking function away from the bank. The bank can no longer make the spread. Now, that day will never come, but it can happen for the 1%, the 5%ers, you, because you're learning how to do that. Now, right off the bat, I haven't given you guys any golden nuggets on how this happens, but I'm planning on doing that, okay? I want you to understand how this is done because it's quite simple. Everybody understands that I just showed you, right? You understand that? You see now how a bank is in full control. And the other thing I didn't ask, but did you have any say in what the bank lent your money on? If you put 100 grand in the bank, did you get to tell the bank that you wanted to lend to this Mr. Smith person? No, they didn't ask your permission. They didn't ask your permission for anything. All they did is said, hey, deposit your money in our bank and we'll pay you interest. Oh, and yeah, we got to charge you for checks. We got to charge you for NSFs. We got to charge you this fee, that fee, bank statements. Oh, you want paper statements? Yeah, we got to charge you for that. Oh, and my bank just sent out a memo to everybody else saying, hey, for cash deposits over a certain amount, we're going to charge you a fee for depositing money. For depositing money in the bank is going to charge me a fee, cash money. Sick. But if you understand that, then I look tall on video. You know, every time when I go to an event and I'm talking to people, they're always like, wow, I thought you were taller. Nope, a whopping 5.4, but I appreciate the compliment. So right there, 500%. Okay, so now up on the board, I put up the machine. So this is where we're going to take a step. Now, if all of you understand what I just showed you, you understand, number one, how a bank is in full control. And I proved that because they don't ask your permission. A bank doesn't take on a lot of risk in doing that, okay, because they're using money and lending it out with a collateral position on an asset. Banks always want an asset position. They want collateral. That collateral can be a house, a car, a boat, a second position mortgage on a house. That collateral could be you personally guaranteeing the loan, because you all have a human life value, which means throughout your life, institutions, insurance companies, banks, Wall Street, all know you have a value that surpasses what you think your value is, because your ability to earn into the future has a literal dollar value to it. The more you can earn, the more human life value you have. So if you personally guarantee a loan, the bank is literally saying, okay, you've got all these assets personally, so you're collateralizing the loan with that, but your income producing ability is also collateralizing the loan. That's where the personal guarantees come in. A lot of people just think the personal guarantee is just whatever money you have in the bank, 401k, and that's part of it, but it's your human life value that they're really hyper focused on. So this machine, I mentioned earlier, we're going to talk about this machine here. Why did R. Nelson Nash decide that he wanted to use a whole life insurance policy as the machine for the infinite banking concept? Has anyone ever given that any thought as to why a whole life policy, right? Out of all the other things out there in the world, in the financial world, why a whole life? You know, some might even say, well, why not an IUL? Well, number one, they weren't around back then. They weren't around when the Rothschilds and the Rockefellers and the Morgans and the Stanleys kind of pioneered this privatized banking thing of using insurance companies as a way to do their banking because insurance companies were safer. I got a whole video on my YouTube channel, The History of IBC, and that's basically what it does. It goes back all the way to the Rockefellers, the Rothschilds, the Morgans, the Stanleys. I mean, talks about Ray Kroc, Walt Disney, talks about Doris Christopher, talks about the dude, you know, the sitting president, Joe Biden, and talks about all of the people who use insurance companies, specifically whole life insurance, as a banking function. Okay, well, they all use it. Why are we told that whole life is the worst place to put your money? And why would they use whole life versus all the other things? Well, how many of you think that a whole life insurance policy would be the worst place to put your money? Anyone? Just put I in the chat. It's okay. That's what I thought when I first heard about this. Does anyone think that would be the worst place you'd want to put money, especially if you're trying to design a private banking system? Why the hell would I use a whole life insurance policy versus a brokerage account, a money market, a high yielding savings account? What is the proper name? Joseph, it's whole life insurance. Yeah, that would be the proper name. So whole life insurance. Used to think so. So we got some people. So Marcelino, Richard, let's see, Jeffrey. So we got a couple of people that are saying, yeah, that would be the worst place. But let's just put a pin in that, okay? Now, what I want to do is I want to talk about what would be the ultimate place you could put your, like if you could put your money in the ultimate machine, what would be some of the things you would want from that place? Like if you could design a bank account, a savings account, and had all the things that you would want, tell me right now in the chat, what are some of those things that you would want? And if you guys don't go fast enough, I will, yes, and engineered. Good call, James. It is not a normal whole life. It is designed and engineered. That's what we're going to get into. But let's talk about what would be the ultimate thing that your perfect savings account would have. In the chat right now, tell me, what would you want? Because I'm going to kick this off. Number one, well, if it was the perfect savings, I would want liquidity. Okay. What else? Anyone else? Compound interest. Okay. Let's use Lisa's. Okay. So 2, you would want your money to earn compound interest. But most bank accounts or savings accounts earn compound interest. Okay, so that's really not anything different than what they do. But what if, and Lisa, I'm going to pose this to you, what if you could find a place to put your money where you earned compound interest, but it was uninterrupted if you took the money out? So remember, I started by saying liquid. So what if I took all the money out and I still earned compound interest? So let's just write uninterrupted. Hopefully I spelled that right. Okay, uninterrupted compound interest. Can we just agree that that's a little bit better? Uninterrupted compound interest. Got it? Okay. Protection. Jeffrey said protection. And I actually saw somebody else write safety here. I'm just kind of reading these as they come in. All right. So protection and safety of your hard-earned money. I love that. So actually, I'm going to use that word, safety and protection, because really they're two kind of the same, but protection, yeah, we'll just write protection. What else? Somebody else said something else. And listen, folks, I'm trying to just use yours. Will, I love that. I mean, come on, folks. I know the government does a great job of managing our tax dollars, but you really think you might be able to do a better job? So how about this perfect savings account? Let's make it tax-free. Anything that it earns is tax-free. But let's talk a little bit about that. I got liquidity, Lionel, tax-free, protection. What else we got? What would you be earning uninterrupted interest on if you took all the money out? So Edwin, let me just hit that. So let's come back up here. Uninterrupted compound interest. Remember that one that we were saying, the perfect savings account? It would be uninterrupted. So let's just use a thing. Let's say you put $10,000 into this perfect savings account, and that $10,000 was earning, I don't know, let's just say 5%. Okay, I'm just picking a number. So if it was earning 5%, but then you got an opportunity over here to invest in, I don't know, what, let's just say you got the ability to invest in a real estate deal. I'm just got to pick something. So this is your real estate deal. So you take the 10 grand out and you put it in the real estate deal. Wouldn't it be cool if your perfect savings account still paid you the 5% on the 10,000, even though the 10,000 was over here in the real estate? So that's kind of what I was referring to. And remember, folks, we're just spitballing. We're just making the perfect thing. Non-inflationary. Okay. All right. Let's put that up. Non-inflationary. Okay. So in order to be non-inflationary, another word for that would be your money would have to earn enough or have the ability to earn enough to beat inflation. So right now, let's just say inflation's 3%. Today, the target is 3%. Year ago, 2 years ago, we might have been 7, 8%. So you'd have to beat inflation. You'd have to be able to pace inflation, which right now, let's just say it's 3%. Fair enough? Freedom. Okay. Freedom is freedom. And I'm going to go one step further with freedom. I'm going to say that would be freedom of time. So a couple things, I'm going to put that on here, okay? But it's not really something that the machine could do, but I'm going to put freedom, because uninterrupted compounding interest, your money being able to work for you 24/7 without ever losing the ability to earn, that would provide you time freedom, because now your money's working for you 24/7. You folks cannot work 24/7. You need to sleep, you need to eat, you probably want to take a break out here and there, you want to see your kids here and there. You can't work 24/7, but your money can. If you had a place where your money was able to work 24/7, that's very key. Protection against creditors, love that, got that already. Let's see. Oops, you said we were getting, oh, so Michael, yeah, that was just the bank example. It doesn't matter. You want to say 4%? We can put 4%, but I like the number 5. Does anyone like 4 better than 5 or 5 better than 4? Does anyone like 5.5 better than 4? Right? The higher the number, the better, right? So somebody's doing the math. I love this. Michael Chafee, you said you were getting 4%, 20 minus 4, 4 times 100 equals 400 more, not 500. So you're wrong. You're doing 20 minus 4, Michael. Remember, the 20% was already netted for the 4% you were earning in that bank account. So I'm not going to go backwards, but you can go back and watch the recording. The recording of this will be up on my YouTube. But Michael, I love that you're doing the math, but the one thing you missed, and I did say it, but I went over it quick, so I kind of get that you could have missed it. When I said you're making 4, and then the bank I went through and I showed all the spreads. Remember those spreads, I netted those out for the 4. So I did 7 minus 4, 8 minus 4, 9 minus 4, 12 minus 4. So we netted the 4% out. So we were just talking about the net spread the bank made was 20%. So then what we did is we took the 4 divided by the 20, because if you're making 4, you're just going to divide that by the 20, because the question was how much more is the bank making than you in that scenario? And it was 500, not 400. But you're doing the math right. You're adding the 4 back in. So by doing the math the right way would be good, right? So you guys like 5.5, 10, odd numbers. There we go. There we go. Thanks, Will. Okay, great. So is there anything else? I mean, we didn't really talk about growth, right? I mean, we did say non-inflationary. So that would be 3%. But let's just say, you know, like here, if I had a perfect place to save money, I love the word guaranteed, okay? So I would want guaranteed interest. So now this is kind of an interesting thing. When you talk about guaranteed interest, to guarantee interest, you want that guaranteed interest rate for the rest of your life. So like, for example, if we need to beat inflation, so if we want it to be non-inflationary, I would want a guaranteed interest rate of at least 3.25%. And I'm doing that, the 3.25, just because if inflation's 3, actually the inflation normally averages 3.2. That would be the normal average. It might be a bit higher now after what we just went through, but I'd need to beat that. So I'd want guaranteed interest that beats inflation's average, okay? So you can't just look at one snapshot in time, because some of you are like, no, inflation's much higher. I'm looking at the average over a long period of time. And that is 3.2, maybe 3.25. So if you earned 3.25, then now you've got a place to save your money that is non-inflationary. But let's go into overdrive here. You know, one thing I like, how many of you own stocks that pay you dividends? And every single quarter, month, however your stock is operating, you get a check for that dividend, right? How many of you have ever received dividend checks? Put I in the chat. I love dividends. I do. I've always loved dividends. So I'm just going to put down here that I would love a dividend check at least once a year. Okay, so dividends, and I'm just going to put yearly. Now I know it'd be nice to get it, but I just, if I'm getting guaranteed interest and I'm getting compounding uninterrupted dividends yearly, is just fine by me. Is that okay by everybody else? Everybody else okay with dividends? Yeah, I kind of like dividend paying stocks, but the problem with dividend paying stocks is there's risk. So I don't want risk. So again, like let's go 9 over here. 9, I want no risk, which I kind of already answered that, but that would be the guaranteed, but that would basically mean no risk. I mean, are we all on the same page here? Does everybody like what I'm saying? These are all the things, right? Does everybody like this? If you had a place where you could do this, and let's just say guaranteed interest and dividends was 5.5%, because that was the number I used earlier, that'd be okay by all of you? I'm just putting some numbers up on the board, okay? But I'm just saying, like, if a place like this, if it worked, if you had a place where you could put your money, that it was liquid, it was compounding uninterrupted, it was safe, and protect it against creditors. If you had somebody slip and fall on that piece of real estate that you bought, they can't sue you for the money in this account. This money's protected. So I think all of you like that. Tax-free, do I need to say any more? Non-inflationary, which basically means like we got to beat inflation. Okay, and if we're going to beat inflation, let's do that guaranteed. Like now, I know a lot of you have bank accounts right now or have over the last year that pay you 5%, high yield savings accounts. It is not uncommon to find one that pays 5%, is it not? But is it guaranteed at that interest rate for the rest of your life? Because if it was going to be non-inflationary, well, damn it, it's got to be non-inflationary for your whole life. Bank accounts, we get so caught up in these like little microscopic periods of time in our life. We're like, oh, well, I'm getting 5% on my bank account. You're getting 5% on your bank account. I guarantee you one thing. If any of you are earning a good rate of return on your savings account, your CD, your high yield savings account, I'm going to make you a guarantee right now because I like that word. I guarantee in September when Jerome Powell drops interest rates, your high yield, ultimate, amazing savings, high yield savings CD is going to drop in value. Maybe not your CD, but after it matures, it will. Guaranteed. Because banks, they give you interest rates, but they don't guarantee them. There's a big difference, okay? So just kind of hitting that. And also, hey, listen, how many of you have kids? Any of you have kids? Put kids in the chat. Any of you got kids? Oh, no penalties. Okay, so no penalties. Let's do that. No penalties for withdrawals. I don't think there's penalties for withdrawals in banks. They just make it hard to get the money from the bank, okay? All right, so we got kids. All right, so a bunch of you have kids. Wouldn't it be cool if that place where you're putting your money, the day you died, which we all will die, that we could leave our kids a bunch more money than what was in that account? So if we started an account with 10 grand and we died the next day, wouldn't it be cool if our kids got 100 grand, like 10x? I'm just making things up, right? But so I'm just going to put over here, money paid to family when we die. But bank account pays to your family when you die, right? Yeah, it's got to go through probate, but eventually some of it will make it to your kids. But isn't it just dollar for dollar? If you had 10 grand in your bank account and you died tomorrow, it would go to probate. Well, actually 10 grand wouldn't, but if anything over 50 grand here in New York State would go, anything under 50 grand would go directly to your kids. But if it was over 50 grand, it would go through probate and your kids would get the remaining amount after probate. Fair enough? But what if we could make sure that all the money that we have in the account is passing to our kids or our beneficiaries without probate, no probate, without taxation if there's gains in there. And like I said, let's put a kicker on it. Let's make it more. So now we could go on this all day long, but I think all of you right now, you'd love to have this, right? You'd love to have all these things. Remember I said earlier, the machine we use for this process, for you to become your own bank, for you to do what a bank does and earn a spread and all that stuff I just showed you, has and always will be a specially designed and engineered whole life insurance policy. And when I said that and I asked people, hey, how many of you think whole life is the worst place you can put your money? And I had a couple of people say that, but I bet you if none of you had known about this concept that I teach, all of you would have said whole life, no way. You would have said the same thing I did when I first heard that, because I thought whole life was a terrible place to put your money. I was a stock guy. I was like, put your money in ETFs and mutual funds and money markets and all that. That's what I did for a living. But see, when I boil it down and I remove the word whole life and I just talk about what it does, and then I ask you if that's what you want, which all of you confirmed. All of you wanted liquidity. You love the idea of compound interest. You probably like the safety and protection thing. I mean, there's not a single person here that didn't like it tax-free. Craig said non-inflationary, so beats inflation guaranteed, so we'll hit those two. Freedom of time, well, you get freedom of time if you're beating inflation because now your money is working for you 24/7. Some of you like the dividend idea. No risk, I think all of you would like to take less risk than you are today with your money, but no risk would be sweet. And then over here, money paid to your family with a bonus. Is there anyone that doesn't want all of this? Is there anyone on here that doesn't want all of this? I just want to make sure I got the right people, because if some of you don't want this, you're probably in the wrong place. Everyone, so, okay, no one's chatting. So all of you want that. Do you realize that every single thing up here, actually including this, no penalty for withdrawals, because there is no penalty for withdrawals, everything up here, what vehicle can give that to you? Does anyone know? What vehicle, what savings mechanism, what savings machine can give you all of those? April, I'm happy to talk to your financial guy. I come from that world. 16 years as a high-level advisor. Put me on the phone with your advisor. They won't like me because they'll see me as a threat. They'll think I'm trying to take money from them, which I am not. I'm just trying to help them understand this. Send them my 90-minute video. April, I'm happy to get on the phone with an advisor. Do it all the time. Shauna nailed it. Sonia nailed it. Yeah, Gold said, well, besides whole life, I don't know any. Do you all realize this is what whole life gives you? This is the why. In life, we're searching for a why. We do things for a why. We go to work for a why. My why is my daughter, but we all do things for a why. I outlined all the things. We can now assume we are all looking at a common goal. And the common goal, while we're doing that exercise, is we all want the same thing for our money. We want all of this. Maybe a little more, maybe a little less, but this is all what we want. And folks, this is what a whole life insurance policy, let me preface, up here, this has to be specially designed and engineered. Compounding interest on an uninterrupted has to be specially designed, has to be specially built for that. Tax-free, I mean, all of it is, but I'm going to put specially designed because you can build it so it's not. That's going to come with them, freedom guarantees, dividends, no risk. The rest of it's all kind of standard with a whole life. This is why we use whole life, folks. I'm not a wizard. I'm not a super extra smart guy. I'm really smart in what I do, and that is money, but I'm not brilliant by any means. I'm not a Yale grad, okay? But I understand that these are the things I want, so there's got to be other people out there that would want this. This is why a whole life insurance policy that is specially designed and engineered to be used for banking has and always will be, mark my words, always will be the machine we use.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
So now that we understand that, and we understand that a whole life policy can give us all of that, it's really important that we understand the banking function. I kind of already talked about it because I showed you the bank, but now that we can identify that a specially designed whole life policy is what we're all after. So I'm going to put that over on the left. And if you want to save your money, and we already identified as savings as 10% or more, and it can be any number. I'm just using the numbers I mentioned earlier. Okay. We want to change one thing. If you could get all that stuff in one machine and one institution, would you make one change? Simple. Change where this goes first. The money you save, just don't put it in the bank anymore. Don't put it in Wall Street anymore, because Wall Street ain't giving you guarantees. Maybe certain aspects like fixed annuities, and we do all that stuff too, but put it over here in the specially designed whole life. I'm going to go through the numbers, and I want to get moving with that. But first, let's just talk about the process. Remember I said all the reasons to do this, but we're just going to talk about the guaranteed interest and dividend. So the one thing I didn't really say, you probably didn't pick up on it, but the guaranteed interest and dividends on a whole life insurance policy right now with all the companies we work with and we design them with, the lowest, and I think the lowest is 5.5. Craig, LLIC, where are they at with dividends now? Aren't they a little higher than that, or are they a little lower than that? I can't remember where they're all at. They all just increased dividends. Oh, also, yeah, hey, folks, if you guys got a dividend, wouldn't it be cool if the next year your dividend went up? Well, that has happened now for 2 consecutive years. Dividends have gone up. All right, folks, with the Q&A, the questions in the Q&A, I promise I'm going to get them. Let me just see. Let's see, just got the answer on a Zoom replay. Awesome. Thanks, Gene. I just want to make sure. How can a whole life insurance policy provide these benefits? So, Antonio, how can a whole life insurance policy provide these benefits? That's what it was designed to do, folks. Let's just hit the basics. In your whole life insurance contract, a bunch of people earlier were telling me that in their whole life just got approved. Okay, so if their whole life just got approved, I can basically tell you one thing for certain. Their contract goes in and explains their guaranteed interest. Now, I don't know what company you're with, but if it's with one of our companies, see, I'm not that dumb. It's 3.25%. It's right in your contract, guaranteed for the rest of your life. So that's why. Dividends, we're only dealing with, okay, so Antonio, we're only dealing with mutually owned life insurance companies. Keyword mutual. A mutually owned company has no stockholders. The owners of a mutually owned insurance company essentially are the policyholders. And because the policyholders are technically owners, they benefit by the profitability of the insurance company in the form of a dividend. But the dividends, by definition, are not profits, because then you'd have to pay tax on them. Dave Ramsey's so smart in his right mind. Notice I said in his right mind, he's not right. He's just right in his right mind, okay? Dave Ramsey says, oh, those insurance companies, those dividends, they're not even dividends. They're just a return of unused premium. When I heard that, I'm like, damn, he's right. He's got me. He's got me, those dividends. Those dividends that mutually owned insurance company give, yeah, those are just returns of unused premiums that were paid. But essentially, if I was getting a dividend from Apple, that's sort of just me getting a piece of unused income that wasn't spent. So it's kind of the same thing. But then I went one step further, and call me silly, but I used my left brain. Dave uses his right, in his own right mind brain. And I said, wait a second. If the dividends that the insurance company pays me yearly, if those dividends are a return of unused premiums I paid, that makes them tax-free. Oh, yeah. So there you go. Dividends are tax-free. And all mutually owned life insurance companies, at least as far as the ones we use, which we use 5 of the top 5 mutually owned life insurance companies, they all pay dividends. But they don't just pay dividends, they have paid dividends consecutively every year they've been around. And most of the companies we work with have been around longer than 130 years. How do you like those apples? Never missed one, never once. Not during the Great Depression, not during the Great Recession, not during the pandemic, and not in this next recession that's coming next year. Never have they missed a dividend. So I went far on that, but Antonio, whole life is designed to provide all this. Safety and protection, okay? In almost all states, there is protection of your cash value. Your policy, your life insurance policy, is protected against judgments and liens in most states. Every state has a little different threshold. Florida's unlimited. So you could have $10 gazillion in your policies in Florida. Someone could trip and fall and sue you, and they can't take any of that money. Fact, look it up yourself. Now, let me just pause real quick, folks, and I'm gonna skip the questions here. I'm gonna get into the process, and then I'm gonna show you a design. Okay, that's what we're gonna finish up with. But before I do that, I gotta share, this lovely little disclaimer. Can you all see that? Okay, I'm gonna read it. Any opinion expressed by me or my castmates, which I don't have any today, is solely our own individual opinion, and it is not investment or personal financial advice. This content is for informational purposes only, and this information should not be relied upon for investment or other financial decisions. Nothing contained herein is financial, legal, or tax advice. I don't have to read the rest because I'm not selling you anything today, and I don't have any affiliates on here today, but had to get that out of the way. All right, so back into it. Actually, before I get back into it, this is a perfect time. So folks, are you guys liking what we're doing so far? You guys liking what you're learning? I'm going to get into some really cool stuff next, but you liking this so far? Awesome. If you wanted to spend 2 days with us virtually from the comfort of your house, office, wherever you're at, toilet, I don't care where you're sitting and watching it, August 9th and 10th. We've done these before, and we're doing it again by popular demand. We're doing an advanced, let me repeat that, an advanced infinite banking concepts training. 2 days. We've got an unbelievable roster, some great speakers coming on, and all we're talking about all day for 2 days is strategy for you to become your own bank. Different ways to use your banking system, different flavors, different strategies, different ways to design policies, all sorts of stuff. 2 days, August 9th and 10th. We're doing this event again. We've done several of them, but we haven't done one in a while. The cost for these, and we'll put the link up in the chat right there. Shauna just put it up and all the details. So if you're brand new and we have never worked with you and we've never set your policy up, it's a whopping $67 for 2 days. We're going to pour our hearts out about IBC for 2 days, $67. And also today, I got a little special offer. I'm going to send every single person that registers for this event today is going to get a t-shirt. I just need, if you register for this today using that link, I'm going to mail you a shirt, okay? All I need to know is I need to know your size. It's going to be a cool shirt. They're all going to be different. We're going to send you really cool, unique shirts that are all IBC related, but I need your address. So if you register today, I need you to also email Shauna at chrisnaugle.com. Shauna, can you put your email up on there? But that's what, you just click that link, and it's a 2-day IBC advanced training. There's the link. Here's the other thing, okay? Not only you're going to get a shirt, just need your size. If you already have a policy, if you're a client of ours, which there are over almost 14,000 as of today, we have almost 14,000 clients in the United States. It just blows my mind how much impact we've had, but we need way more. If you're one of our clients, your cost for this 2-day training is $47. Okay, so we're benefiting people that are taking action. T-shirt for everybody, $47 if you've got a policy already with us, and $67 if you're just getting rolling and you haven't done one. Fair enough? Okay, so there we go. All the sales out of the way. Let's dive in. Back to the board. And keep putting those questions in the chats. I'm definitely going to hit Gene's. Okay, will there be a replay? Yes. On my YouTube channel, we put replays up of every single one of these, so I got that one out of the way. And what's the name of the video you mentioned on your, it's the history of the infinite banking concept, the history of IBC at the Chris Naugle. So that's how you'd look at that other one. I'll get these other two questions from Deborah and Chris in a bit. All right, so we're going to hit that ceiling. Here we go. Policy. 5.5, I think, is the lowest. Now, if you're going to take back the banking functions, remember how the bank had a circle? You remember that? Remember how I said the bank moves your money around the circle, does different things, and every single time the bank makes a spread. You remember how I said that? Okay, each time the bank turned your deposit into an asset, it was then making a spread. Okay, so here's the thing. We're going to need a bank. So we still need a bank account. So before we even get started with the infinite banking concept, here's the one thing all of you would need to do. You need to go to whatever bank you bank at, and I need you to open a second checking account. Fair enough? So I'm just going to write that down. Second checking account. Now, what we're going to do is we're going to call this bank account a segregated account. They go by many names. It's just a stupid checking account. There's nothing fancy about this checking account at all. Matter of fact, a couple rules: do not get a debit card. No debit cards allowed with the segregated account. Now I'll explain why we're going to use this. Now, the other thing that we need is over here on the right side of the circle. We need an opportunity. Okay, so we're going to call this over here the opportunity zone. So what are the opportunities? Well, let's think back. Where are you giving up the banking functions in your life? What things are you using money for? Well, let's just write a couple things. Let's do a car. Okay, all of you probably drive a car. Okay, some of you maybe have a boat. Let's see, let's try to draw a boat here. There we go, there's my boat. There's your boat. Some of you have a boat. Some of you have a house. Some of you, unfortunately, have credit card debt. Some of you have other debts. Okay, we'll just write debts. And some of you have none of these or don't worry about any of these, and you just love to invest money. And you can invest in real estate, crypto, miss the P, crypto. You can invest in private loans on privatemoneyclub.com. So anyway, these are all your opportunities: cars, boats, houses, credit cards, debts, investing in everything else. Got it? Every one of these, with the exception down here of the investments, has a payment that you are making. Car payment, maybe $700. I'm going to draw an arrow over here. Boat payment, maybe $1,000. Boats are pretty expensive. House payment, maybe you're $1,600. Okay? Credit cards, payments, I don't know, maybe they're $500 a month. All I'm trying to do is show you that every one of these things you have, debts, maybe they're, other loans, maybe they're $200. See the arrow on the right side? It's pointing away from you and your bank. This is your bank. This is your private banking system. Okay, I'm just going to write private bank right here. It's a specially designed whole life. Forget about what it is. Just remember what it does. Okay? It's not what it is, it's where it takes you, or whatever that baby boss statement is. It's what it does that you want. And all of you agreed to the common goal that we all wanted those things on the screen. And it does all of that. So over here, we need to make that money go to work. Because, hey, listen, some of you might be okay with this, but are any of you okay just making 5.5%? Because I'm not. Sorry. Call me greedy, call me whatever you want. I'm not okay with just making 5.5%. But that's a good starting place. Would you guys agree? Would everybody agree that 5.5%, 5%, whatever your number is, that's a good starting place? But I want to go make more money. So car payments. Who here has a car loan? Anyone have a car loan? Anyone know their interest rate on their car loan? Anyone? Who can tell me what their interest rate is on their car loan? 6 to 7%. Let's use 7. Is that okay? 7%. All right. Is 7% more than 5.5? Yes. Would you rather earn 7 than 5.5? Yes. But wouldn't you like to earn 5.5 and 7? Or somewhere there close? Yeah, you would, right? Okay, so Let's just go right from the top and then we're going to move down and then I'm going to give you numbers. Fair enough? So if we're making 5.5% and we want to pay off a car, or maybe you just want to buy a car and that car has a car payment of $700 in this example and it's a 7% interest rate. What we would do is we would go online or make a phone call to us and you would take a loan from your whole life insurance policy that we designed for you. Fair enough? You take a loan from it. Now, some of you are thinking, loan bad. Why would I take a loan to pay off another loan? That doesn't make sense. Now, hear me out. The loan you're taking from the insurance company really never needs to be paid back. But that's kind of a lie. It's going to be paid back whether you like it or not, because you're going to die. I don't know when. I hope not anytime soon, but you're going to die. It's one of the certainties in life. So the loan that the insurance company is giving you, let's just say they charge you 5%. Now, each insurance company we deal with has a different loan interest rate, but they're all right around 5%, give or take. Okay? So you can all say 5.5 is more than 5. So I think it's pretty safe to just say that we've just figured out a way to make a spread. Because if you're making 5.5 and you're paying 5, you're making a spread. But I didn't get to the whole thing. You see, every whole life policy has a cool thing, and that is called the death benefit. So because every whole life insurance policy has a death benefit that the insurance company in a whole life, because it's for your whole life, knows they have to pay to you someday, the insurance company is glad to lend you some of your death benefit while you're living up to the amount of your cash value. Okay, we'll get into cash value in a second. So if your cash value in this case, let's say this car, $40,000 is owed on it, and let's just say your cash value for today's purpose has grown to $50,000. You got $50,000 in cash value. Your car is $40,000 that you owe. Okay, so what we do is we take a loan for 40 grand. I'm just going to write $40,000 right here. Where did the 40 grand come from? I already told you the benefits of the whole life. It didn't come from your cash value, because if it did, you wouldn't be earning interest and dividends on 40 grand or on 50 grand. Actually, can I make this simple? I want to keep this even easier. You got 40 grand in cash value and you're going to take a loan for 40 grand. Okay. I just want to kind of, in your mind, I want you to rationalize that if you had 40 and you took 40, you got 0 left. Everybody got that? Okay. And in practice, you'd need more than 40 to take 40 out, but just trying to get that through. So if you have 40,000 in cash value, the insurance company, without any questions, well, they do have a question. What bank account you want it deposited in? Is this part of a divorce decree? And are you illegally smuggling or laundering money? Just things like that. The insurance company will give you $40,000 from their general account, which their general account has tens of billions, if not hundreds of billions of dollars sitting there waiting for you to die. Because they promised that if you die, you'd get a $500,000 death benefit. Actually, this one would be more, but let's just use 500K, just making up a number, okay? They promised you, actually here, let me just do a mil. It's easier math. $1 million. If you die, $1 million is paid to your family, but you're living. And you want to use some of that cash value to buy the car, but you don't want the cash value to leave your account because you want to earn interest and dividends on it. So what the insurance company is going to do is they're going to then say, okay, we'll give you 40,000 of the 1 million that we're going to pay you. So if you die the next day, 40 grand will be subtracted from your death benefit. We're going to basically give that 40 grand of your death benefit to you while you're living, but we're going to collateralize it with the $40,000 in cash value. Simple. You've now just found a way to earn interest and dividends on your full balance while still being able to use it. Yes, there's a cost to using it, but this is simple interest. This is compounding interest. Do I need to explain the math between simple and compounding? Because compounding always trumps simple interest. We have calculators. But all I'm trying to get you to understand is we made a spread. And all of you are going to just look at the static spread. You're going to go 5.5 minus 5 is, you're going to say 0.5%, okay? You're going to say, I make 0.5%, which isn't much. But I'm going to prove that that's not what you're making either. Let's keep going. We paid the car loan off. We no longer owe the car finance company $700 a month. But game is not over. The game isn't over. You're the bank, folks. You can't steal from your bank. You didn't steal the $700 from the car payment. They would have come and repoed your car. So if you took 40 grand from your bank and you basically use that 40 grand to pay off their bank, what should you do next? Well, the $700 you were giving them, well, you should pay that $700 back to your bank, right? Because you were already giving that money away. We're not recreating money. We're literally just repositioning the money you were giving away. And now what we're going to do is we're going to take that $700 back. We're going to put it into that segregated account. We're going to set up a loan repayment to the insurance company, to your policy, and we're just going to pay it back into your policy, which every single $700, whoops, not 700,000, $700 payment you make back is reducing the loan to the insurance company. Now, here's the problem that most people, and this is where that person got tripped up. So I want you to pay attention. Some of you are looking at this and saying that's stupid. Okay. You're saying that's stupid. Well, you know what was, and let me correct you. What was stupid is the fact that you had 40 grand sitting somewhere and you were making payments of principal and interest at 7% to someone else's bank when you could have just paid that loan off. That's stupid. But now that you no longer owe $700 for that car payment, what are you going to do with that $700? Put it in the chat. What would you do with that $700 if you no longer owed it to your car payment? What would you do with it? Pay other debts? I like that. Buy a dishwasher, invest. Before all of that, thank you. You'd save that, right? That $700 that you used to pay on the car is now savings before somewhere else. Then you could buy a dishwasher and all that. Was kind of a funny thing. You could invest it and all that. But yeah, you would save that money. That would become savings. You'd repurpose $700 that was a payment to savings. Do you realize that's what we just did? By completing the bottom part of this circle, by putting the $700 a month you used to give away back in your policy as a loan repayment, you are saving $700. How? You're thinking, that's a payment back to the insurance company. How am I saving it? Because every dollar of that $700 loan repayment is money you can use the next day. Damn it, that is savings. But mathematically, there's some more things. I told you you're making a spread here, okay, between what the insurance company pays and what they charge. You're also making a spread over here. You were, if we just flip it around, 7 minus the 5 the insurance company paid, you're making a 2%. That's spread 2. Okay, so you're making a spread of 2% if we look at it this side. But not only is it just the spread of 2. If we pay a loan down, if we were paying 5% on 40 grand, but next month we paid $700 down. Here, let's just do this. I want to do this for a year. Run out of time, but just stay with me here, folks. 700 times 12, 8,400, okay? So in 1 year, that $700 payment would have reduced the loan against your death benefit by 8,400, which means now it's not 40,000 getting charged 5%. It is now $31,600 being charged 5%. Do you think you pay more interest on 40,000 at 5% or more interest on 31,600 at 5%? Of course, 40, right? The higher number means more interest is paid. So every time you save the $500, or sorry, the $700 you were giving away to the bank for the car, now that $700 became savings because it's now in your cash value. It's now usable the next day. That is savings. But what it also did is it reduced the amount you're paying interest on, which means every time you save more money, your spread goes up. Mathematically, you don't have to do anything different. I get so fired up over this. Hopefully, every one of you understand what I just told you. Dexter's like, showtime. Do you understand that? By you not giving control of your money away to somebody else on your debt, the car payment, by you just making that same car payment, turning it into savings, but saving it inside the policy as a loan repayment, you lost no liquidity of the money. You actually gained back $700 a month in liquidity. But not just that. You earned interest and dividends on all the money, and because you're paying the loan down, your spread is going up. And your spread is going up because you're paying less interest to the insurance company because every payment reduces the amount of principal that you're being charged interest on. Not to mention that, let's go back to the 40 grand. The 40 grand never left your account. The 40 grand's been earning 5.5% compounding. So next year, is it 40 grand compounding at 5.5? Nope. It's 40 grand plus the interest and dividends you earned compounding at 5.5. One is going up, the other is going down. Your spread is increasing. It doesn't take a genius to figure this out. It's just freaking math. Folks, when I figured this out, when I learned this, I'm like, son of a bitch. Where has this been my whole life? Because it's so simple. It's been right there with you your whole life. And then once you pay your car off, well, damn it, pay the boat off, pay the house off, pay the credit cards off. But you've got to do it in the proper order. This is what we help clients with. We put everything in the proper order, which is usually lowest balance to highest balance, because then we can get the velocity of money working faster. And once all the debts are gone, because why do we start with the debts? Well, hell, folks, Some people said I would take the money and I would invest it. Hold on a second. Your credit cards that you have probably are charging you 20 to 25%. I need a new screen. Okay. If you have credit cards, I can tell you right now, the average credit card is being charged 20% in interest. 20%. So if you got credit cards, you're paying 20% and you got money that's leaving your family every single month. The payments, they're gone. You can't get them back. And 20% in interest is what they're making on you. Now, a lot of people would be like, well, I would just invest the money. Great. How much can you make for investing the money? I just did a YouTube the other day and we looked at a whole bunch of different periods of time in the markets and we looked at just bull markets. What was the average return? Right around 14. I think it was around 11%, but let's round it up to 14%. Back to what we started earlier. Is 20% better than 14? Who would rather make 20 over 14? 100% of you. Now, to take and make 14% in the stock market or investing that money, it involves risk, right? So to invest the money, you have to take risk. If we just paid off the credit cards from lowest balance to highest, is there any risk there? No. So no risk. And when you pay the credit cards off, what if we just took those payments and we put them back into your savings? Exact same payment, you just put it back into savings. When you're done paying the credit cards down, you put it back into savings. What was your return? The exact same amount you were giving away, 20%. Not hard. Why they don't teach this stuff in school, why every single one of you watching this right now doesn't already know that, and most of you do, surprises me, because that is not difficult. But yet people will go out there and invest their money, risk losing it, and in some cases lose it, when all they needed to do was pay off their freaking debts and save the money that they used to give to the debtors. It just forever will haunt me that that's what's being done. But folks, all I want to do is over here, this circle. This circle represents one of the most, so you're making a spread, you're making money twice on the same dollar, but the only thing I want you to really understand is we have literally just taken back the banking function in our life doing this. By changing one thing, where your money goes first, by adding one step, how you use your money, you have now taken full control of your money back, and you have now taken back the banking functions in your life. If you kept doing that, if you kept applying that I just taught you, it would be impossible for you not to have more money next year than you have this year. It would be impossible for you not to stay wealthy once you get there, because you're not leaking any money. No money is being leaked. All the leaks are filled and patched because you paid all the debts off. Those are the leaks. Taxes. In the future, we have minimized taxes because everything is growing tax-free. We can't get rid of taxes, but we've minimized them in the future growth. We've plugged the holes. Now, bonus round or final part of this. Everybody liking this? Yes, we can absolutely do this in Canada. I'm gonna hit a couple questions. Larry, yes, we can do this in Canada. We have a partner up there. Okay, they're great. Jason Lowe is his name. If all you wanted, Larry, if you want to be referred up there, you want us to give you their name and number, just send Shauna at chrisnaugle.com. Send Shauna an email, just say Canada, and we'll get you hooked up. Is there a ceiling on the initial deposit? Marlon asked. Yes. So let's come back over here. That policy, okay, that private bank. When we build the private bank, we can build it for any dollar amount you want. You can save any amount you want. You can say, I want to save $500 a month. I want to save $5 million a month. No problem. But the real question was, is there a ceiling? Yes. Whatever we decide you want to save, that's going to drive your death benefit. Your death benefit is also going to drive the IRS rule called the MEC 7 pay rule. The MEC 7 pay rule will determine how much more or less money you can put in. But is there a ceiling on how much money you can put in? Your ceiling is only based on your human life value. Your human life value is what drives your ceiling on your deposits. That is it. So book a call with us. Shauna, can you put the link up? If any of you are interested in learning more about this, getting on the phone with us and diving into your circumstance, then we'll put a link up to book a call, and then we can kind of dive into what it is you're looking to do, what your problems are. And Christy, you know, you were saying, can you get a policy with a serious health issue? Yes, but it might not be on your life. We might need to borrow a life, like a child. So if I was ill or sick or just had a critical illness or a chronic illness that I could not get insured, I could take out a policy on my daughter. I just did a second policy on Vivi, did it with a company called Guardian because I live in New York. and I did $7,500 a month. That is Vivi's second policy. She is now 4 years old. So Vivi now has 2 policies making up her banking system, but I control the money. I'm the owner. So right there, Chris, you could do the same thing. If you have somebody like a spouse or a key employee or a child, they could be the insured while you own it and you control it. In ownership comes control. Will the 2-day seminar apply to Canadians? You're darn right it will. Larry, the concepts that we're teaching are identical, whether it's Canada or US. The only difference in Canada is how the policies work. Up there in Canada, as you probably already know, you guys are sort of socialists from a government standpoint, so therefore they love to tax the shit out of you. So the only difference is your policies up there are not quite as tax efficient as ours, but we can get into that on a call or when we connect you. So yes, it definitely works in Canada. And the 2-day seminar will absolutely, everything we teach in the 2-day seminar will apply in Canada. No difference. Deborah said got a $250,000 HELOC with 599 12-month intro. That is freaking awesome. Need to strategize. Book a call. Shauna, put that link up to book a call. Let's strategize, Deborah. Or Deborah, you have my number. Just hit me up. Let's strategize. All right. Whether or not your husband's keen on, you don't need to do life insurance. So this is always funny. Deborah said, you know, she got this great HELOC, 250,000, great intro rate for 12 months, but her husband isn't keen on life insurance. No problem. Let's not put the money in life insurance. You know, your husband certainly would be keen on life insurance if something ever happened to you, Deborah, and you were no longer here. He'd be like, why didn't you have more death benefit? Where's your life insurance? But now he doesn't want life insurance. I get it. So, hey, all right, let's not do life insurance, but let's get that money working for you a lot of different ways. Got lots of strategies with that. Dorina said, so I own my assets, house and car. Where do I start? I want to buy a new house and a car. So Dorina, you start by booking a call so we can build a plan. Every plan, remember I said specially designed and engineered. Every plan we build, which I'm going to get into next. Okay, I got 10 minutes to get into the design. We're going to custom design and engineer your policy for your specific needs and goals. So there's no set amount you have to put in. We're going to design it around what your goal is. And whatever your goal is, we'll reverse engineer it and tell you exactly what you need to build and do to hit your goals. And then you make the decision. Great questions. Wow. Well, Deborah's was great. We got Anonymous said, once you BYOB, would you ever have a need for credit cards? Heck yeah. Would there be a point where you leave your regular bank? You're always going to need a bank because remember that segregated account. But I mean, I'm a perfect example for both of those questions, Anonymous. I use credit cards all the time, but I never pay any interest to the credit cards because every month I pay the credit cards off. That's part of my system. Shauna, like when we do events and everything, when we rent cars for this event that we got coming up in 2 weeks, like 100% credit card points paid for all the rentals. I think she rented like 5 luxury SUVs to cart us around for this event. 100% paid for by points. So of course I'm using credit cards. I just decided that I was going to take back the banking function. So I'm using them. It's kind of like, you know, if you ever dated somebody and they used the shit out of you, like they just used you for your money, for your house, for your car, you got used. Well, I'm a user. I use the credit card companies bad. I'm surprised they haven't dumped me yet. They gotta look at my accounts and say, man, this Chris guy, he's using probably $1 million a year in credit and we haven't made a single penny off him and we have paid him back in points this much money. Fire him, dump him. He's a user. I'm a user. Yep, I use those dirty banks because they used me my whole life, so now I'm using them. Can you own a policy on anyone or do you have to have a specific relationship? Great question. You have to have an equitable relationship or an equitable benefit. There has to be some reason that if that person dies, it impacts you. If a child dies, obviously impacts you. If a spouse dies, impacts you. If a key employee dies, it impacts your business. You got to replace them. So there's got to be something. Book a call with us and we can kind of go into that. And how do I get a policy for my 2-year-old grandchild that potentially may be autistic but not officially diagnosed? Oh my God, Deborah, get on the phone with us. Don't ever use that word when you're talking to us. If it's not diagnosed, you've got a short window to make this happen. The only thing you got to understand is if they're diagnosed within 2 years, is a 2-year contestability period where the insurance company, if something ever happened in those 2 years, could not pay the death benefit. They'd give you your money back, but that's your only risk. Okay, because you already know what you know, but we don't need to know that. Get a policy on that child. This might be your only opportunity to protect that child's future insurability forever, for their family, for everything. This is your only opportunity. I'm just being honest with you. Get on it. Okay, that's all the questions. Now, we design policies lots of different ways, but what I did is there's a policy design that we came up with that I thought was really cool. And, you know, in going through this, I wanted to teach you the process, show you kind of some of the math behind things, but I wanted to give you some numbers on a policy. So I just grabbed one. So first thing, I'm just going to give you the stats. This is on a 43-year-old male, okay? 43-year-old male in good health, okay? Good health. And this is a real client of ours right now. I can't give you the names, but I'm going to give you the numbers. We designed a policy with one of our carriers, one of our favorite carriers, a giant mutually owned life insurance company. And we designed this one really unique. This client had a unique goal. They had money sitting in a bank. So here we go. Over here, they had money sitting in a bank. And I don't know, we'll just call it $132,000 sitting in a traditional bank account earning nothing. And they said to us, he said, hey, listen, I want to change where that money goes. I want to put that money into a specially designed whole life. Great. So this is called a dump in, okay? One time. They had this money sitting in a bank and they wanted to dump this money in one time into the whole life. So now this whole life gets a deposit of 132 in year one. So it's actually 131, give you the exact numbers, 650 first year, dump in. But this client also did not have 131,000 to put in every single year. So they said, well, if I put 131 in, what's the lowest? This is how they solved. This is what their need was. What's the lowest amount of premium deposits I can do each year? Great. So we went into the insurance company. We looked at the MEC rules. Dump in 131,000 in the first year. Your minimum, I need freaking glasses, not literally. All right, there we go. Much better. $11,650. Okay. But then the client said, well, okay, but what happens if 1 year I can't make that premium deposit? And folks, this is something that's happening a lot of. Is it okay if I go a little over, everybody? Would you mind if I just go a few minutes over? Because I got to cover this. There's a lot changing right now. Things are getting tough for a lot of people, and a lot of people are starting to say, hey, I got this whole life policy, but I can't make those premium deposits. What do I do? I just created a video, and we're creating a fact sheet for every single one that might be kind of pressured right now by the amount of premium deposits. Maybe like, oh my God, maybe I got to surrender it. I got to lapse this policy. I can't do this. Folks, don't do that, because there are so many options. For this particular client, the min max, so I'm going to hit that one. The max amount this person could put in is $131,650 the first year, and the maximum amount each year was $11,650. But what was the minimum? Well, the minimum was $6,196. So people all the time forget, when we build these policies, we build flexibility. So I'm just going to write flexibility right here, okay? The flexibility for this particular client, writing sideways, was $11,000 to $6,100, min, max. So everybody understands that. So how we designed this policy is we designed this policy for premium funding from years 2, because this is year 1, year 2 through year 10. So I'm just going to write this, year 2 through 10. So 3, 4, 5, 6, 7. I'm going to run out 8. I'm just going to go up to 8. But years 2 through 10, that was the amount we were going to put in. Okay. So now what I want to do is I want to show you how this policy grows. This is what people care about. All right, Chris, if I put this money in the policy, how much money can I use? Well, this client put 131 in. So now we're just going to talk about cash value. And I just want to write over here, death benefit. So the death benefit on this policy, just so all of you know, was $2.865 million. So if this client passed away, here, I'm going to write it so you guys can actually see it, 2.865 mil, okay? So we protected this person's family pretty darn good. All right, but most people really just care about the cash value. So that's what we're going to talk about, which surprises me. I know the death benefit's important, but a lot of times people are like, well, I just want to know how much is my cash value? Not how much does my family get if I die, just how much is my cash value? So this policy, I'm going to do this in a different color, just so you guys can see this. All right, actually, let's do this in bright red, maroon. So they put in 131 the first year. They have access to 120,694,000, which is 91%. Not bad. But some of you would argue this. Some of you would have a hard time with this, and you'd be like, well, Chris, that sucks, because if I put 131 in the bank, I can take 131. You can, but if you put 131 in the bank and you take 131 out, or if you put 131 in the bank and you take 120, how much is left in the bank? Pretty much nothing, which means you pretty much defeated the purpose of earning interest on your money. But if you put 131 in this and you take 120 out, how much is left in the policy? 131, right? Earning interest and dividends. And this policy, this company pays about, I think it's 5.6%. All right. So 91%. But some of you would then say, yeah, but Chris, oh my God, like that's a lot of money. How much money did I lose there? Well, you lost, let's do the math. So $11,000. Yeah, about $11,000. So your first year, you are negative $11,000. But your family is positive 2.865 million if you die. This is an ethical thing that all of you are going to have to deal with. That's it. There's a cost for the death benefit. Insurance companies, and you don't want them to be nonprofit, insurance companies are for profit. They make money. They charge for the death benefit. We get a commission, although very small. This design, we get a commission that is 90% less than a regular agent's commission would be, because we give up 90% of our commission to design the policy this way. Okay, you can figure it out. It's 90-10 year one. So $11,000 is what you gave up to provide your family with 2.865. Sucks. But how many of you would be okay giving up $11,000 right here, right now, to be guaranteed that for the rest of your life you'll make more money every single year than every year you'll have more money than you did the year before? Every one of you would take that. And not only that, you'd always be protecting your family, right? So that's the trade-off. 120. Now in the second year, how much do you have? So the second year, you put 11,650 in, and you've got 129,101. Now let's talk about this. So if you just did the math, you put 11,650 in, and you grew by 129. So if we subtracted that out, you're down this year, you lost 3243. So now our total loss isn't 11,000. Our total loss is 14,243. Okay, so we have given up 14,243 of our deposits to pay for a death benefit. Got it? Here's where it gets super fun. Now, every year beyond this, every dollar you put in, you will take out more than you put in. Let's go. Okay, so pay attention. All right, so the next year, you remember you're putting 11,650 in. What's your death or your cash value? 142,200. Whoops, 140. Yeah, that's right, 142,200, which means now we get rid of the negatives. So I'm going to change from red, and we're going to go to dark green, because that green means good. Green means go. So now we are plus $13,099. If we net that out, we subtract the premium deposit, the 11,650 from the 13, our net profit, net profit after death benefit costs, net profit after policy service fees, net profit after commissions and renewals to us. How much did you make? Well, you made, where's my number? 1448, I think. And it's simple math. I just got it. All right. So then every year, and I'm just going to give you the numbers. The next year, and I'm going to leave out the cash value, because remember, and also folks, this is very important to understand. So we made $13,099. We put in $11,650. We made $1,448. Let's just do the math. It's third year. Cash on cash return. So we take the net amount, $1,448. Okay. We take that amount. And what we do is we divide that amount into the $11,650. This would be how you'd look at your investments. How much money did I make on my deposits this year? You made 12.4%. That's all. Just 12.4% on your money that year. So your 11,650 you deposited made 12.4% cash on cash. But let's keep going. I'm going to go quicker now. So the next year, we're fourth year in, you make 14,335. You put 11,000 in. The next year, and I'm just trying to show you the growth, you make 14,952. The next year, 15,584. Anyone see a pattern? 16,234. I didn't go any further than that, but folks, if I keep going, if I were to show you all these numbers, if I kept going, what do you think is going to happen? Do you think the numbers are going to go down? No, they're only going to go up. They can only go up. They can only go up whether or not the money is in here, this money, this money. See, the goal with the infinite banking concept is not to just do what you've done your whole life, take the hard-earned money you earn, put it into an investment, put it into a savings, and just leave it there. The goal is to make that damn money work for you twice. Why would your money only work for you once when it can work twice? Twice meaning let's put the money in the whole life where we're going to earn interest and dividends, and then let's take that money out, this 120, let's take it out, and let's make that money go to work again. Now we made a spread, and then we're making whatever returns our money does, and we don't affect this. You realize every year in this particular design, if we took the cash value out every single year, we put in 11,650, we took out the 1399. We put in 11,650, we took out the 14,335. We put in 11,650, we took out the 14, which you wouldn't be able to take 100%, but about 90, 92% you could take. If we did that every single year, do you know that the numbers wouldn't change? Do you know that these numbers would be exactly what they are, regardless of whether or not the money was used or not a second time? The only variable we need to factor out is, remember, that pesky, greedy insurance company charges you interest on that loan. I'm just going to use 5. So just doing the math, just on year, what was that, year 3, 12.4 minus 5. Everybody okay with that? And obviously you know that 14 is more than 13, so the return's higher. Minus 5, minus 5, minus 5, minus 5. But the numbers are going to keep going up and up and up and up for the rest of your life, forever, forever. Why would you ever let that go? Why would you ever surrender that? Why would you ever even think that this is a disposable asset, that you should get rid of this? Under any circumstance, find a way to keep this. Always find a way to keep this. And I don't care if that means changing the mode from annual to monthly, reducing down to the minimum amount, reducing your paid up additions. Look at RPU options, reduce paid up options. Look at dropping death benefits. You really need 2.865. Great. What if we drop the death benefit down to 2 million? How much is your premium? Is that affordable? If we drop it down to 1.5 million, is that affordable? See, folks, there's tons of options. I've got a video we just made all about this. I'm happy to give it to you secretly and not telling anybody. But folks, if any of you are struggling to make your premium deposits or think you're going to struggle, please email Shauna at chrisnaugle.com and we will send you the video I created on all of your options. Don't ever let your private banking system go bankrupt. Don't ever let your private banking system go to somebody else. Don't ever let the insurance company take this back, but through a lapse. Don't surrender this. This is one of the greatest assets you will ever have. And it is not this or stocks, this or Bitcoin, this or real estate. It is this and all of those. You put your money in here, you take the money from here, you invest in whatever you know, like, and understand. Do you understand? It's not a decision. You don't need to decide, oh, should I do this policy? Or, gosh, my husband wants me to invest in the S&P 500. Do both. Put the money in the policy first, take the money out, and then invest it into the S&P 500 if that's your flavor. Then now your money is perpetually and forever earning interest and dividends. The one thing that I realized when I talked to this person that was here the other day, that a lot of people are missing, and I have gone over this probably for the better part of a decade and missed this. Remember the circle? Remember the recaptured $700 from that car? Remember we had the car up here that was a $700 payment? The thing that I always missed is I always said, well, take the $700 you used to pay to the car finance company and write yourself a check for $700. The thing she didn't understand, and the thing a lot of people probably don't, is all you're doing is converting liabilities to assets. You are taking payments and making them savings, and there's no one in the right mind that thinks straight that would ever not want to do that. When I told her all you're doing is, instead of paying $700 to someone else, you're saving $700. She's like, oh my God, I get it. Those payments are now my savings. I just increased my savings by $700 and I didn't have to take any risk and I didn't have to work any harder. I just replaced and removed money, reallocated money. And to me, I was just like, yeah, I'm just like, I thought you knew this. But sometimes, folks, it's so simple. And sometimes that thing you're missing is just this micro little thing. It's just how it's said. So folks, as we wrap, I want to thank all of you for your time today. I said your time is the most valuable resource. You just gave me an hour and about a little over an hour and a half of your time. There's nothing more valuable than that. So thank you. Thank you to all of our military, our vets, all the men and the women protecting the freedom that we have in this country. Thank you for your service. And just all around, thank you for wanting to learn something new. Thank you for not, having arrival syndrome. Thank you for not thinking that you know what you don't know. Thank you. With that being said, folks, join us for that 2-day training. Grab yourself that free shirt that we're going to mail. How many of you took advantage of that? Anyone take advantage of the 2-day IBC advanced training that we're doing to get the t-shirt today? Put I in the chat. JD just booked a call. So if any of you want to book a call with us and my team just to talk about your situation, we're not going to try to sell you anything. We're just going to try to solve your problem. If we can solve your problem, you will ask us to help you do that. We won't have to sell anything. We don't have to sell you a policy. We don't have to do anything. We just have to solve your problem. And we will do that. Thank you, Gal. Appreciate it. Unanimous said, how do you determine the min-max? So that's a great question. So Unanimous over here in the Q&A asked, how do you determine the minimum and maximum amount? Easiest thing in the world. We don't. You do. All you're doing, remember, is changing where your savings goes first. I don't know how much money you save. You're just going to tell us, hey, I want the ability to save X amount monthly. I want the ability to save X amount annually. I want the ability to move this amount of money. We build the policy around you and your needs and goals. We design and engineer every policy. This policy was designed and engineered around this client's needs and goals, not your needs and goals, their needs and goals. Their policy design will be different than yours because your needs and goals likely are different than theirs. So that's how we figured that out. Great question. Membership price for the 2-day event. What was that, Shauna? $47.67. If you're a policyholder, it's $47. If you're not a policyholder, it's $67. What does membership include? It's not really membership. Oh, what does membership include to get that? Oh, sorry about that. So yeah, the membership that we're referring to is you just have a policy through us. You set up a policy and you're doing the infinite banking concept through us. There we go, 47 and 67. Shauna, can you put that up there one more time to the link to sign up for that so I can get that over to Sandy here? I just want to copy and paste it real quick. We got a lot of chats. Deborah, thank you. And please, 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 Deborah, take what I said to you very seriously about that little one, that 2-year-old. I can't stress enough. It literally will be your last opportunity. Before diagnosis, it's your last chance. And I'm not saying that to try to force you into doing something or anything like that. I'm being as real gets with that one. Mr. and Mrs. Rays, how do I get a policy for my husband, Mrs. Rays? How do I get a policy for my husband and my daughter? I already got mine. Book a call. That's it. Just get us on the phone and then tell us what you're looking to do. Especially easy since you already understand it because you're already doing it yourself. So let me just give you let's see, Shauna put this cool thing up. So right at the very bottom, if you want to book a call with us, Mrs. Rays, there is at the very bottom the link. And folks, if anyone else wants to book it, I know it can be hard going up in the chat. I just put it there. These are all the things. So Shauna just kind of put all the links, my YouTube channel, my link tree for all the events that we have. We've got a really cool thing now. If you want to know what our events are coming up, we just have one place you go and you can see every single event. You can register for every single event right there. It's awesome what she did. And at the very bottom, if you're interested in booking a call, it's mentors.beyourownbanker.com. All right. Well, that wraps up another episode of the Wealth Webinar. And all of you, I appreciate you being here. We'll see you this afternoon for the Ask Me Anything happy hour. Until then, have a great day. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.